Well, let's see if we can find some of those 5 and 10 bankers and take a look at your pro picks.
Yeah.
Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, before we get to your top ideas, I want to revisit your past ones. JP Morgan, Fairfax Financial, Agnico Eagle, all have done tremendously well since you were on March 6th. Your average return is up 53%. So that has definitely outperformed the market. JP Morgan, you touched on, you still like. Respect Financials, JP Morgan is the best house in a good neighborhood. Fairfax, you did touch on a couple of times, but I want to expand on that. We get a lot of questions about why Fairfax isn't more widely held. Probably every Canadian fund manager will own Royal or something like that. And like Fairfax, has it not earned that position in fund managers' books?
Yeah, it's just not that liquid. I think that's the biggest issue. And it's a little more opaque because of all of their investments in privates. And so it's a little harder to understand. But there are some real disciples. Fairfax has outperformed Berkshire over time. And a lot of people don't realize that. So they have just been very, very effective at making good decisions when it comes to their investments over time. And as Warren Buffett has shown, this property and casualty business is a pretty good business. You're basically managing the float if you can make good investment decisions.
So you continue to like it here?
We do.
Your third one, home run, 95% return. That's Agnico Eagle. This maybe is a good opportunity and time to talk about most people, if they owned gold, you've doubled your money in a year. Again, that can feel uncomfortable to make so much money in a short period of time.
Yeah, and I understand that. I mean, the reason they're called cyclicals is they do bounce around. There will be a correction at some point over the next few months that will be hard to stomach. These will correct 30% at some point. If you look at the bull market of the 1970s, there were 3 very distinct legs in the bull market, interrupted for several months at a time, a couple of times. So we are now, way above the moving averages, but you can't sell something because it's overbought in a bull market. So you have to have your own strategy, and we'll use our stops. So I think if you're looking out over the next 7 or 8 years, what started 18 months ago will wind up being 10 baggers. And so we'll see. Agnico is just the institutional favorite, and it's the best managed, and they have done the best job at not making mistakes operationally, and they've got a good growth profile. So it's one that I think an investor can live with a little more volatility and knowing they got a great balance sheet. It's a dividend grower, like we talked about earlier, and it's a multi-mine company in safe jurisdictions.
Let's go to your top ideas now, all mining focused, but maybe a little bit smaller cap. Maybe we can take those risks in this market where things are starting to broaden out. Hudbay Minerals is your first idea in copper. And we haven't talked too much about the fundamentals of copper, so I'd love your perspective on that.
So we are going to be in a deficit of supply in copper, given all the things that are happening in the world, AI and energy transition and so on. The interesting thing about commodities and the reason they have long-term bull markets is because when they go out of favor, boards of directors get put in place to make sure the CEO doesn't spend any more money to get them through what is a bear market. What it means is by the time you wind up with firmer prices, there's no new production coming on. And so copper, like some other commodities, went kind of like 10 years with only a couple of big new projects coming on, and tech, of course, had one of them. So now we're facing what will likely be a deficit in production. And so we want to own things that are going to benefit from that. Hudbay has really good growth opportunity with their Copper World mine. And it's been de-risked. Mitsubishi just announced they've come in and they're funding the rest of the development, $400 million. And so now Hudbay can focus on the cash flow that will generate from this. And so the history is that precious metals perform well first in a secular bull market. Then the copper stocks and base metals companies join in. Of course, we're seeing that. And so, again, don't be afraid of the fact that they've had this great lift because it could go on for a long time. And then the last thing is, of course, as an intermediate-sized company, Mitsubishi may at some point decide they really have to own the rest of it. And that would have to come at a pretty good premium.
So a takeout as an option, free option, but not necessarily.
Yeah, we don't own it because of that, but those are the types of things that happen to mid-sized producers.
Okay, let's move to another metal, precious metals. Your idea as a streamer, Wheaton Precious Metals. Yeah. Why take this approach? I guess you have mining exposure.
Yeah.
So what does streaming get you?
So one of the things that we're thinking about is, what will happen when we do see a correction. And so the streamers in general will have less volatility. Wheaton is the most exposed of the streamers to silver, more than Franco, for instance. And they have a higher growth in production. And so they have more growth in their revenues. So of those two, Wheaton is the one that we would focus on. For the investor that doesn't have exposure to precious metals, and there's tons of them. I mean, I talked to a very senior investment advisor yesterday by happenstance, and he said, do I really need to have some of this in the portfolio? Because it's just not something I focused on. I said, well, it's a good choice. There may be a better moment at some point over the next few months to do it. I don't know when we'll get a correction. But yeah, you sort of do have to. We look at precious metals right now as the alternative to bonds. I mean,
like when you say precious metals, are you talking gold or are you talking silver too?
Okay, gold and silver and the producers are the hedge against inflation. Bonds are a hedge against disinflation. So we've thought for 40 years bonds are the safe asset because interest rates were falling and the risk of falling prices. I would say the big risk today is inflation and the loss of purchasing power. So actually, gold is less volatile than a treasury bond for the first time in 45 years.
How do you measure that?
One volatility versus the other. And it's been that way for about 12 months. So we think one of the most important hedges for investors is to hedge their risk against inflation. Dividend growth is one way, financials are another way, precious metals are another way. It can move around day to day, but I think the long-term trend is higher.
I want to spend a beat on silver because we've talked about gold and all the reasons you're optimistic there. Silver is a little bit more of a spicier metal. It can move swiftly up and it can be a heartbreaker. And right now we've seen a parabolic move in silver. What do you do with parabolic moves? Because you like momentum. Do you like when things go this bananas?
As a momentum investor, you have to embrace it. And you just have to have discipline around your exit. So everybody can find their own way. And yes, it is sort of going parabolic as it is right now. Stanley Druckenmiller would say, if you find a bubble, lean into it to take advantage of it. And you just have to be disciplined around it.
Can we talk about that discipline in terms of percent corrections? Like, are you afraid of 20%?
I think you have to, in a bull market, you have to be willing to accept a little bit more volatility because there's more upside. But yes, we'll follow our positions with trailing stops. But the reason I talk about Wheaton is because if someone's a longer term investor, they can stand a little volatility knowing that this has got such a great balance sheet and such great dividend growth and such a broad asset base that it's going to be around and it's going to continue to thrive.
Okay, your final one is actually an energy pick, and it's Headwater Exploration. And I'm curious, why you like this name. We've actually been hearing a lot about it from some of our energy-focused guests saying, look at the Clearwater play.
Yeah.
Everybody's focused on what CNQ is up to, what Suncor is up to. Look at these headwaters, these tamaracks, because that's where growth is. What brought you to Headwater?
Well, you just named 4 of our positions. Okay. First, I started out with the backdrop that energy is likely to join this bull market. Second, there are some companies in this sector in Canada that have gone through major transitions, are very, very strong from a balance sheet perspective, have very low costs, and are showing themselves in the market. So yes, if you look at the XOP, which is the U.S. Producers ETF, doesn't look that great. And if you look at oil price, doesn't look that great. So why is Headwater, trading near new highs? The fact is they have incredibly low costs. The Clearwater is a very productive play. And in their case, they're using multilateral drilling, and they have very low decline rates. So like 20 to 25% corporately, which is really, really good. They're using waterflood to optimize their production, and they have a break even of like $35 a barrel. So when we enter a sector that maybe is early, we want to make sure that we're not dependent on it getting better for us to make money. We want to know we're making money already. So I think 2026 could wind up being a year where energy catches more of a bid. And we want to start with the strongest companies we can find, technically and fundamentally. This company has a great balance sheet. They've got low cost, operationally strong.
Do you own Tamarack too?
We own Tamarack as well.
Okay, another Clearwater play. You did say that I mentioned some of your other holdings, Suncor and CNQ, and I want to spend a beat on CNQ because everybody asks why it's underperforming. And one of the questions has come about return of capital to shareholders because they've got some spending. And so one of your theses is you have to be a dividend grower. I think there's anxiety about CNQ's ability to be that. So where's your conviction on CNQ?
So CNQ is incredibly well managed. They have incredibly good long-lived assets. They also have a huge, natural gas base, which is sort of an option. Somebody said to me one time, a very smart energy investor said, think about an energy company as an option. You don't know when the price is going to rise on the commodity, but what you're buying is what's in the ground and their ability then to sell into those rising prices. And CNQ is a perfect example of that great optionality. Yes, they have a history of capital spending to grow, but they grew because of it. So you can't really penalize them for that. We are in an era where these companies are likely to be huge cash flow generators and great dividend growth stocks. I don't think that the fact that they're spending money to grow means they won't grow their dividend as well. Capital return is going to continue to be an important part of their culture. Are
you violating your own practices by owning CNQ? Just because looking at the chart, it's a really muddling along chart.
If you pull the lens back.
Yeah, longer term is much better.
Take to like a monthly chart.
Okay.
First of all, it's trading above 50-day. It's trading above the 200-day moving average. It's not a problem there. A 50-week and 200-week. But if you look at the very long-term picture going back, it was in a bear market from 2008 where it topped out around $34 and finally traded through into a new bull market in the beginning of 2021. So in the last bull market, stock went up about 700%. That was between 2001 and 2008. Stock is corrected and consolidated. The long-term picture is very bullish.
David, what a pleasure. Thank you so much for joining me. The audience would have killed me if I didn't ask you about CNQ, so I had to squeeze that one out there. But thanks so much for your insights and your ideas today.
It was really fun being here.
All right. Make sure you tune into our next episode. We've got Chadwick Westlake. He is the new CEO of EQB. This is one of the smaller Canadian banks and has the crown of being one of the worst performing in 2025. those tend to be the best performing the following year. We'll see if EQB has got the strategy in place to become a winner this year. We'll get perspective from the CEO who came in during difficult times after the sudden death of Andrew Moore, who was the CEO. So we'll talk about all of this. Don't miss that episode next week.